Hi, Larry Gaines, Power Cycle Trading. One of the most difficult things in trading is to try to identify and confirm a market bottom that's safe to start to get back into, from a buy side. So I'm going to take you through a four-step process that I use, and then a trading options strategy that's a high probability setup kind of strategy to use selling options. So first off, here's just an example. So QQQ, this is a NASDAQ 100 ETF, and you can see we've had this massive, sell-off here over the last 2 days. So we had what we call a volatility squeeze here as a daily chart, and you can see that the price has just collapsed to the downside, and now it's currently trading below the 200-day moving average. So very, very weak price action here. So what you want to do, you don't want to try to just take guesses and shots and say it's too oversold, because you'll just get run over like a freight train. So I've got a directional trading process that I use, and I'll take you through that, and then I'll show you an option selling strategy that's set up for a high probability winning type setup. So let's take a look. So the last major sell-off we had on the market in general was back in January of this year, okay, 2018. So there's QQQ. You can see it broke down early January and had just a massive sell-off, and came down here on November the 20th and had that low, retraced back up, sold back off, came back again. So what you want to do is, go through kind of a directional process that will lead you to a safe entry point. So what I like to do is use the 4-hour time frame, also combining and aligning with the daily. But let's take you through the steps that I use on a 4-hour time frame to identify a safe tradable bottom. And it's a kind of a four-step process, so let's go through it. So I've designed a trading system that's based on momentum, overbought, oversold, and reversal signals. So first off, I like to use the 4 hours a little bit faster than the daily. So step one, you can see down here, this is my cycle reversal indicator. So you can see there's a reversal here. This came on 12:30 p.m. on the 9th of February. Okay, so that's step one. Now step two is I want to see my overbought, oversold indicator here. This is called cycle 3. Go back above that 80 percentile. So there it is above that. So you can check that off. The next thing you have to have for any kind of price change up or down out of a cycle, you need momentum to turn it. So I like to look at cycle 1 as momentum, a really fast sensitive momentum indicator, and then I want confirmation with cycle 2, another momentum indicator. So that gives me this yellow arrow. That gives me a signal to say, okay, it's safe if you want to try to take a trade to the upside. All right, so here's the buy signal that came on the 13th of February. So you can see this process, it takes a while. You've got to be patient, but here would be your signal to get in. And so what I like to do, the first kind of safest trade setup is to do an out-of-the-money bull put credit spread. Try to do 1 standard deviation, because that gives you about an 80% probability that should be a trade that price will be above your strike price. So let's take a look. So I like to use the index, the NASDAQ 100 index. This is a good one. It's a European option, and the contract size is good. So we don't have a signal today, but what I'm going to show you is what I would do. So if we had a signal like this based on my indicators, then the next thing I would do is I would go to my option chain, and I would look to sell an out-of-the-money bull put credit spread at about a 15 or 20 delta. So close to 1 standard deviation out-of-the-money bull put credit spread. Now you could do this with QQQ, but this would be when I'd look at index, or you could use QQQ. So I'd go out and I'd look for like a 20 delta, about an 18 delta, 20 delta. That's going to be very close to that kind of 1 standard deviation out of point. And so let's say we did a 20 delta short. So that'd be selling the 66.25 way down here. You can see where the market's trading here, 69. It'd be down here. So it'd be something like an 18 delta or 20 delta. Let's take a look here at the 20 delta. So the 66.25 short, the 6600 long. So you get $404.10 credit, or $410 credit, and then your risk is the difference of 2,090. So that's your margin, but that would be about a 20% return. Now, the reason that you would look to do this, and not, again, this is not a setup I'd be doing now because we don't have a signal, but it's a high probability trade. If you go into this and you did a 20 delta, that's giving you about a 80% probability that the price will close above your short strike here, which would be 6,600. So hope that helps, and I look forward to talking to you on the next video update.